Welcome to Kirk Spano's Fundamental Trends webinar on Friday, May 25th. And we're going to talk about how to trade this market really over the summer and into next year. So it's probably a 9-month or to maybe a 12-month game plan that I'm laying out here for all of my subscribers. And we're going to talk about a few things that are going on right now. If you hear a little buzzing in the background, after allowing the grass to grow to about 27, 28 inches, the service finally decided to cut it after I called them. So, I got 2 acres, so I let somebody else do it. In any case, let's talk oil. Let's get started right off the bat with oil. Why is oil getting pummeled? Well, I have a few theories here, but the main one is that there was an unexpected inventory rise the other day, and people are freaking out. Well, I'm here to tell you that freak out is your opportunity to get into oil stocks and oil in particular if you haven't yet done so. And I'm telling you, you probably want to do it today after this seminar. Here's the reason. So going into the Iran sanctions, Saudi Arabia was aware that was going to happen, right? It wasn't a surprise. They've been talking about it with President Trump for a while. So Saudi Arabia exported a little bit extra oil to the United States over the last month or two going into the Iran sanctions. I would suppose that they did that to help mitigate the possibility that there'd be a price spike in oil. Now, we all know that Saudi Arabia wants the price of oil to go into the 80s. How do we know that? Because they said so. And that's probably a pretty good reason. So they have the Saudi Aramco IPO coming in the next, 18 months, maybe this year, who knows. But it's coming, and they want the price of oil in the 80s. They want everybody to understand that the supply of oil will be managed along with demand for an extended period of time, probably until demand for oil starts to turn over, whenever that is. As I have discussed in other articles, and I've put up various charts, including the one that I'm about to put up. Price of oil is going to remain relatively firm until that. Let's see here, I have a graphic for this. Price of oil is going to stay firm until this happens. Where is it opening up? It's opening up over here. All right, it opened up in Paint. All right, so we have the EIA chart here. And the blue line back in here is theirs. And then right about here, I put in my own blue line. And basically what I'm saying is that demand for oil will continue to go up till into the 2020s, and then it'll plateau for 3, 4, 5 years. And then as EV sales start to blow away ICE sales due to a number of factors, including ICE cars being made illegal in many places, demand for oil will start to plunge. But that's where the supply line will come over, right? So until oil stops going up, supply is going to stay just under it to give the price a lot of support. And this is going to last for the better part of a decade. Hence, the peak oil plateau that I have kept talking about is that we're going to get oil in the price range of 80-ish to 90-ish, maybe 100-ish. We know, and everybody knows, as long as the price of oil stays under 100, it really doesn't trigger a recession. But at about 80, it supports all the budgets in the Middle East and is very profitable for our companies, incredibly profitable for our companies now that they've slimmed down. Whether I'm right about where this turnover occurs, it could occur out here, it could occur over here, but towards the end of the 2020s, 2030-ish is when you'd expect demand to start falling off a cliff and go from 105, 6, 7, 8 barrels a day, whatever it gets to, and by the middle of the century, we'll be down to that 50 million barrels a day because demand for legacy vehicles and other uses, ships, will still be there, and some petrochemicals. Although something to know is that petrochemicals are not really going to be using oil forever either. So keep that in mind. There is plenty of substitution coming for petrochemicals, and that's going to be in the form of converting methane into plastics and other types of chemicals. There's already a gigantic private equity-owned petrochemical company down in Houston that has bought supply from a little company called New Light Technologies. And if you don't know who New Light Technologies is, you should know. And if anybody can find a backdoor way of investing in them, you will get rich. I just can't figure out how to do it. And I've been looking for 2 years. What these guys do is they convert methane into plastic. And they can convert it into other stuff too. But already Coca-Cola, there's no small deal. Coca-Cola is already using their air carbon plastics to make bottles. So this is not like theoretical. The petrochemical company that cut a deal with these guys, it was some obnoxious. It was like $1 billion worth of product they bought for over the next 10 years. So this company is going to grow. Other people are going to copy their technology. They'll tweak something so that they, can get around the patents. And so you should be looking for the companies that start doing this. But there are going to be substitutes for petrochemicals. So down the road, demand for oil will fall off, and it will fall off hard. So all these folks who are talking about Exxon and Chevron, you got a problem, right? Houston, you have a problem because those companies are so darn big that they're going to have a near impossibility developing assets that they've written off. They're not going to come back, and then other assets will get written off, and they just don't have the ability to sell anything, right? So who's going to buy Exxon's oil fields? Who's going to buy Chevron's oil fields, okay? And who's going to pay the fines that they eventually get for hiding climate change evidence, which they clearly did. Now, you can debate what that climate change evidence means, but the fact that they had it and they hid it is going to be a big deal. It's going to go to court. It's already in like 5 courts. They're going to have to pay to defend themselves, and eventually there will be a very large settlement. I believe that Exxon and Chevron will end up funding a lot of the conversion over to clean energies because they're going to be forced to. Now, will they get the benefit in that? Probably, because that's what we do. We protect our companies even when we punish them. It's kind of like a child. Go to your room, think about what you did, now come out and clean the dishes, and we'll take you out for ice cream. So, in any case, oil has gotten beat up today. Why? Again, like I said, a little bit rise in inventories. People are going nuts. All the longer, lower for longer people are having one last gasp. I'm telling you, this trade is not going to last long. The oil is not going to plunge down into the 40s. There's pretty big. Where's my lines? They don't want to give us lines. Okay, so I'll switch to another chart in a second. But you have this big drop in USOU, so we're basically round tripping it right now. We're up $2 ish. Most people are up $2. I am going to buy USOU today. You do what you want, but I'm going to round it up because I didn't have a large position. I should have traded it a couple days ago. I didn't. I regret that, but it had a good chart. I think the inventory build caught people off guard. It caught me off guard. I didn't think it was going to happen. I knew that Saudi Arabia probably would send a little bit more oil. I didn't think it would be to the point where we had a build instead of a draw. But you should expect big draws this summer. I don't think Saudi Arabia is concerned about keeping the price of oil under 80. They want to get it to 80. They just didn't want it to spike to 90 or 100. So they're managing it. And you should understand that that is the story. Saudi Arabia is managing the price of oil. We have helped them by putting sanctions back on Iran. You're going to eventually have hundreds of thousands of barrels of oil coming off the international market because nobody is going to fight with us about that. Now, I know that there's people out there who question me in these articles. They've been wrong for a year and a half questioning me. I'm telling you, this is what's going to happen. Iran is going to have to keep hundreds of thousands of barrels at home. They're going to build their inventories. Eventually, that oil will get into the market, but it could be years. So there is no way that Europe and India and even China are going to side with Iran over us. Why? Because we've already sanctioned the Central Bank of Iran. So anybody doing business with the Central Bank of Iran in 6 months is going to get whacked. They cannot afford to get whacked. There's not a country in the world stable enough financially to fight with us economically. Can't be done. So when President Trump says trade wars are easy to win, all right, unfortunately, he's got a little bit of a point in that we can win these trade wars, but it's not easy and it won't be painless. So look for the in-between settlements, look for the marginal improvements on all of that. And this is going to be one of those places where there's just some shifts in where supply comes from, and that supply is going to come from Occidental Petroleum. Yes, somebody just bought Occidental this morning because they're going to be an exporter from the United States out of the Permian, and you've got Saudi Arabia that has 2, and I think really 3 or 4 million spare barrels of capacity when you take into account on what they can get done within about 15 to 18 months, right? So they can crank up 2 million barrels a day within 6 months, and then they can drill some they can extend some of their fields within a year and a half. So we're not going to have an oil shortage, but the glut is over with. We already know that the inventories are down to 5-year averages, maybe even a shade below. So shale, drill, baby, drill, but it ain't going to be enough because with the exception of the Permian, all of the other basins are starting to hit physical limits and economic limits. So you want to be in the Permian players, and that is why I own a lot of Oxy already. I bought Oxy down in the 60s, but I think Occidental is a core position. If you own Exxon or Chevron, sell those, buy Occidental. Occidental is a better version of Chevron and Exxon. So all the people who go, well, but Exxon used to be good and Chevron used to be good and I made money in them years ago, even though they've sucked for a decade. Okay, yeah, if you want to own Exxon and Chevron, I'm going to tell you this. I'm going to short Exxon and Chevron at some point. 2 years from now, 3 years from now, I'm not exactly sure. But I will eventually short Exxon and Chevron. And when they drop 50, 60, 70, 80, 90%, I said that. I think Chevron might have to restructure. Exxon maybe too. We'll see. I'm going to make a lot of money. So don't discount that Exxon and Chevron are both going to lose half someday. And if the lawsuits are successful against them and expensive, you might see these companies, because there'll be criminal proceedings, you can't bankrupt those away. So they'll have to go bankrupt, restructure, wipe out the shareholders, and let the debt holders become the new equity holders. I'm telling you, that is a very real possibility in the 2020s. So I just don't even want them now. Buy Occidental Petroleum. Buy Occidental Petroleum. Buy Occidental Petroleum. All right. So this USOU, I'm going to buy some more of it today. And then if it does have one more leg down, good grief. If it gets into the 50s, I might even buy options on calls on a leveraged ETF and just hold my nose and hope that none of my clients who have made 70, 80, 90% the last year and a half don't fire me for being down 10% in a month. But, this will act as a slingshot. Eventually, it's going to take off back up. All right, so let's just take a quick look at the unleveraged version of this fund. Yeah, so it could drop 20, 30%. I mean, if things really went to hell. But, it's already under its 200-day moving average. The trend is up. Yeah, this is a good trade to make. You want to pick up on this. People dropped out of the money. Shaking the cash flow, the money flow is going down. Let's see if they give us a daily on this. Yeah, get a little daily on this. So yeah, just this is just the inventory news. It'll bounce back up. So I'm not too worried about it. Eventually, you could see oil stocks become a mania, though. Why would oil stocks become a mania? take a look at the companies in here. All these companies have been doing well. Look at this company right here, Chesapeake Energy. Who would have thought 2 months ago to buy leaps on Chesapeake Energy? Hey, hold on a second. Dom, are you talking about what I said about Chevron and Exxon? Dom wants to know what I'm smoking. You bet. All right, Dom, I'm going to tell you this. I've made this case in multiple articles at MarketWatch and at Seeking Alpha. So if you're in Chevron and Exxon, I am telling you right now, you should use these I know I haven't. Look, man, they have so much. Okay, you want numbers? All right. Let's play the Exxon and Chevron suck game. All right, we're gonna play another game later in the show. Come on. All right. When you take a look at their balance sheet, you tell me what you see. Total assets, $350 billion. Do you believe for a minute that they have $350 billion in assets? If you do, you're out of your mind. They do not have $350 billion in assets. Within 90%, you're out of your mind. Take a look at the oil fields that they're at. Oh. All right, so this is what you have to look at with Exxon and Chevron. You take a look at their total assets, and you go, oh, well, they say they have $350 billion in assets. Then go take a look at their charts of where their acreage and where their positions are. And then you ask yourself, one by one, can they develop those at $80 a barrel? Okay, ask. And the answer is going to be no, because a lot of those require tens of millions, hundreds of millions, billions of dollars to develop. And if the price of oil starts to crack in the late 2020s or around 2030, they're screwed. And the market will recognize that years in advance. And you have to realize the curve for EV adoption is exponential already. You know, it's starting from such a minuscule number, right? Huge in the other direction, a minuscule number. But the idea that we're not going to have millions and millions of EVs just a few years from now, and tens of millions a few years after that, and hundreds of millions after that, it's going to happen. You basically are going to see the same sort of relationship with EVs versus ICE cars as you do with alternative energy and fossil fuel energy right now. Right now, in the United States, 100% of all new energy generation is alternative energy. 100%. I'll get there, guys. All right? So that's going to happen with EVs. Pretty soon, 100% of all new car sales on net, right, from versus retired cars is going to be EVs. And it's not going to be 10 years for that to happen. It's going to be 2024, 25, 26, which is what I said when I was in the interviews over in New York in December. Anyway, if you want to analyze Exxon and Chevron, stop looking backwards. Take a look at their liabilities. Take a look at their assets. Okay, so they have liabilities of $150 billion, and then you have to ask yourself how much of this is not really assets, and it's a big freaking number. All right, and they have no goodwill because there's nobody who will buy it. Right, so you got to throw out all the goodwill, and if you throw out all the goodwill, you're in trouble. Book value is only $44. I would argue that that's what the share price should be. All right. So let's go back to Chesapeake Energy. So Chesapeake Energy, which is one of the holdings in XOP, which if you're just looking for great asset allocation, you want to buy XOP right now because it's getting hammered. But when you take a look at Chesapeake Energy, people want to say, okay, so they have $12 billion in assets. They have $12 billion in liabilities, which isn't really true. Their actual liabilities are about $9 billion. But they have the opposite situation as Exxon and Chevron. Their assets are actually probably worth more than what they're showing. Why? Because they're all land-based in the United States. And the natural gas assets are deeply undervalued right now. So if we get a rise in the price of oil and they start to monetize most of their oil assets by selling them off over the next 2, 3, 4 years, and they produce out of just one or two, Eagle Ford Shale probably, although they've already sold a piece of that. I can see them selling all of their oil assets here in the next 3, 4 years. And if they do that, now all of a sudden, say they make $6 billion or $7 billion selling all their oil assets, that leaves them with $6 or $7 billion in natural gas assets. But what else? Almost no debt. So if you want a company that has got the trends in their favor, you want a company where their asset base is going to increase because it's going to get valued higher and higher. Why would their natural gas assets get valued higher? Because natural gas is holding its own in the fossil fuel space. It's still taking share from coal. And globally, the alternatives really can't keep up with all the demand. So there is going to be large LNG exports. Back about 6 years ago, I said LNG exports would end up being close to 20% of all natural gas production in the United States. I believe at the end of this year, we'll be at 12% already. You want numbers? There you go. There was a 1% overhang in natural gas production versus demand, and yet we're exporting going to go on 12% by the end of the year. That's going to cause the price of natural gas to go up. Now, I thought it was going to happen over the winter. Maybe it'll happen over the summer. Maybe it'll happen over next winter. I don't know, but it's coming. I can tell you what's going to happen, just can't tell you exactly when, which is why I use all those pretty charts. So let's go over to XOP. So I am writing an article. And I start lots of articles, and I finish them eventually. Drafts. So the article here is Bulls winning binary bet on Chesapeake Energy. I don't know if that's the article I'll stick with. I might just make fun of the Bears. But, so what is Chesapeake Energy doing? I told everybody to buy those calls a couple of months ago. Those calls are up, 50%, give or take? They're hedging their free cash. They're hedging free cash flow. What does that mean? Chesapeake Energy is going to be able to hedge their oil production around $70 a barrel, and they've and their charts, their estimates are based on $50-something in oil. So they're not only going to beat Stone Cold River Fox guy over at Seeking Alpha wrote an article about how their cash flow is only going to improve because they're selling off asset sales. He doesn't understand the company at all. He's just throwing out something that he said, oh, look, they have to sell asset sales to make cash flow. That is, they've been biding time, waiting for oil prices to come back. They have 40-some-odd% of their production now is oil, and they're going to get $70 a barrel instead of $50. That's not going to materially impact their cash flow next year? Come on, that's dumb. They are going to continue monetizing assets, another one or two in the next year or two, $2-3 billion, bam, debt gone, because they'll be cash flowing on the other production. Coming out the other side, Exxon, I've already told you this, is going to end up being a low-debt natural gas producer focused on the the Marcellus and the Utica, which are basically the Permian of natural gas. Okay, so I still think you can buy Chesapeake Energy. I think it's going to go to between $6 and $8 an hour. That's a double from here, almost a double from here. I like the calls because it was a binary bet. Everybody was betting against Chesapeake Energy when it was $3 a share. Now it's $4. It's going to 6 or 8. You can still buy the calls that we bought. So if you're not a subscriber, you can subscribe and find out what those are. All right, if you're just looking for asset allocation, this is a chance to get in on this around 40. It's just pushing 44. 10% decline. Could have come all the way down to here, this 38. Certainly could. Could have come all the way to 35. Man, if XOP comes down to 35, I am going to back up the truck. I'm going to sell almost everything else, and I'm just going to buy calls on XOP. All these energy companies are going up for the most part. Andeaver won't be on this list soon. Why? Because, and that was now subscribers will know this. The general public doesn't know this. But what happened in January, February? I took Phillips 66 off of our list, right? Because I said it was fully valued. But I said Andeaver I'm leaving on there because they might get bought out, and they still have a lot of ways to run because they have the light sweet crude refineries, which is why Marathon Petroleum bought them. So Andeaver will be gone because Marathon Petroleum bought them. It went up another, 30%. Now it's off the list. It's not worth buying anymore. But you take a look at some of these other companies in here that are all, Marathon's just a great company. Whiting Petroleum, they're a high risk company, but oil is going in the right direction for them. They're not very heavily hedged. So if you want a company that would make money on a spike in oil, probably be Whiting. Occidental, love them. You know why I love them? They're a big Permian player. They have their own pipeline capacity, and they're exporters. Devon Energy, I have that in a couple of accounts. People brought it over because they bought that. I'm not going to sell it. Pioneer should be in here somewhere. It was last week. It's not right now. It'll be back. And Pioneer, of course, is becoming a Permian pure play. Hard not to like EOG, hard not to like Apache. Apache really did a good job on their assets the last several years. Anadarko, Murphy's a good company. The Conoco used to be on our list and it just started going up too much. Hess is a good company. This is just a great basket of companies. You want to just buy the basket, buy this basket, XOP. All right. Enough about oil. Let me run through the questions. No, you don't want to buy Occidental puts, Steve. You sell puts. Revenue stream. Revenue stream not heavily dependent on ICE. Yeah, Exxon and Chevron are very heavily dependent on cars. All right. We'll do a whole show on EVs eventually. I'm not going to talk about it more here. Yeah. Continental's not very hedged either because Harold Ham, who bought me eggs and bacon one day, screwed that up one time, and now he's making up for it. I will tell you, when you screw up once, and I did, I screwed up I screwed up about the same time that Harold Ham did. I had hedges on. I took them off a year after he did and still was wrong because oil went down an extra year. So, all right. So how do we trade this summer? What are we doing this summer? Well, I just want to show you some of the companies that we're in, some of the ones that I've disclosed publicly. And let's just take a look at some of these companies, okay? So there's this little telephone company called AT&T. All right. So why do I like AT&T? Okay, well, first of all, they have a 6% dividend. And we know there's certain things in their favor right now. And one of those things that's in their favor is that the net neutrality rules have been changed. Why is that super important? Well, it's because now that they're going to build out the IoT, build out the 5G and more fiber to support the IoT world, right? The smart everything world. This price level down here is pretty close to this range that it's been in for 7 years, right? Now, could it break down into here? It could. I don't think that it will because that was crisis pricing, right? So once it busted out, it got to here, and then it got to here again, and it busted out, and it's never really gone below there again. I believe we're at the bottom of the trading range. Without the change in net neutrality rules, I don't know if I would have felt that strongly about it. I could have maybe seen another leg down, but because they have to build out a lot more broadband, the change in net neutrality rules is going to allow them to charge Google and Netflix and maybe Amazon more money. Why are they going to be able to charge more money? Because now they can go to those users, which Google and Netflix are about half of all internet traffic. I don't know if you knew that. And so they're using up a lot of the broadband. Google has a division that, is almost, flirts with becoming its own telephone company or its own fiber company, Google Fiber. I don't know if they've changed the name again, but they know that they need to be charged more, right? They're using so much capacity. They shouldn't be paying what I'm paying. That makes sense. They're a heavier user. They should be paying more. AT&T is going to be able to charge them more. Plus the unplugging of America, right? People going to Fire Sticks, um, and Hulu and Netflix and getting rid of their traditional cable packages. That's actually much worse for Comcast and Charter than it is for AT&T, because AT&T, yeah, they kind of got into the cable business, but everybody that ripped on their direct TV purchase a while back, they're just wrong about that. Direct TV now is like a core feature that I think you're going to see on a lot of people's Fire Sticks as they come. More and more people are going to go that route. My grandmother's going that route. She's 90. Why would she change at 90? Why? Well, mainly because we told her to. But, the reality is that, AT&T, Verizon, CenturyLink, they control the pipe that gets the internet to your house, and they're just going to charge you more for it. So if you want 60 speed, maybe you get it for $39 a month. But if you want 100, you're paying $59. And if you want 400, I think it's $99. Right? They just keep dialing you up. Well, if you really want, no latency and no buffering, yeah, pay the extra $20 or $40 or whatever for the higher speed. So we're eventually going to all have the equivalent of the T1s or T3s, so it's just much faster service, and that's coming, and they're going to be able to charge for it now. So expect their revenues to keep ramping up in given years, and their liabilities to keep going down, because their pension liabilities are going to fall off. They've been buying back pensions. I know this. My mother worked there, and a lot of people fall for it. If you work at AT&T, you should not take the buyout on the pension. Keep the pension. The math does not work in your favor unless you're a very aggressive investor. But if you're, a retiree and you're cool making 5 or 6% on your money, you should not be cashing in those pensions with AT&T. Keep the pension. So in any case, AT&T is a company that you can buy right now. $32.78. 6% dividend, almost at the bottom. Maybe it's starting to turn around. You're getting money flow into the stock again. You're starting to see a divergence. It's very early in the divergence. You can wait for more confirmation if you want to, but it just came off of oversold. It's got a long way to run as far as I can tell. Ultimately, I think the AT&T, CenturyLink, and Verizon all move into new trading ranges, right? So these trading ranges that you've seen lasting for a very long time, I think they're going to jump up. I think they're going to break out of these tops 2-3 years from now. And I think they're going to have new trading ranges for a very long time. So I want to buy down at the bottom. I'm buying a little bit of Verizon right now, not as much because I think the management are a bunch of jerks to their employees. But, they have a comparative advantage over there on the East Coast. And I think that Verizon's a pretty good company to own. All those dense cities, they're going to do pretty well. So go ahead and start nibbling on Verizon. What's their dividend? 5%? 4.8, right? And then CenturyLink is the turnaround company here. And this is worth, I don't know if they're going to cut that dividend in half. They might. But I don't care because the stock is already beat the heck. It's already beat up as if it was going to cut the dividend. And dividend investors haven't been buying it yet anyway. So a dividend cut of half would probably be good, because then they could put that money into building out their networks. But the level 3 merger was really what you wanted to see here. So why am I going over telecom? Because telecom, what's the symbol for this? IYZ. Oops, my fault. Because telecom has come off this peak way up here, right? 35-ish. It's already down. It's down 20%. This is the sort of thing that you look for. These long cycles, up, down, buy it. Up, down, buy it. Up, down, buy it. And again, net neutrality changes. Smart everything world coming, right? So you want to get in on that, and this is a great way. This is, if you're a fund person, this is the fund to buy. And I like this fund over some of the others because it has a broader base. It has Cisco, has Palo Alto. I like all these companies. T-Mobile, Sprint's in here, and I don't like them, but eventually, I think Sprint could. If this merger doesn't go through with T-Mobile, I think Sprint might go bankrupt. Either there, or SoftBank has to make major investments. And if they do make those major investments, subscribers know there's a company out there that I think is a takeover target. So there are better ways to have national cellular networks than having number 3 and 4 merge. If we want to keep 4 national companies so that customers get better deals, which is what we should want, we really don't want these companies to merge. You're going to see a lot of price competition disappear. So as a consumer, I don't want the T-Mobile and Sprint merger to happen. As an investor, I want it to happen. Why? Because you're tightening up the oligopoly on national cell coverage, which means higher prices, which means more profits for the shareholders. So look at it from both views, right? All right, so the ebb and flow here of trading over the summer is pretty simple. We don't know what President Trump is going to say on a day-to-day basis. So I'm actually writing a little article, and it's going to be fun. It'll be for subscribers first, and maybe I'll put it out there to the public. But it's going to be, what will President Trump say next? Or what if President Trump says, I think that we can work with Iran. Holy cow. I think that Mexico is doing a really good job on this NAFTA thing. And I think that we pretty much have an agreement. What if President Trump says, we're going to help Russia develop their Arctic oil fields? What if President Trump says, the euro is great for the world economy and we have to help support the euro? Right? What if President Trump says, come on, type something out there. What if President Trump says, Stormy Daniels is a friend of mine, right? Come on. These tweets are so outrageous that people get all fired up over them, and you really have to take a look at the policy behind it. And the one thing that you should be afraid of, that I'm afraid of, I don't think it's going to go this way, but I'm still scared, or as we said as children, scared, is if there really is a trade war, nobody wins, right? We take the smallest black eye in the very long term. We have to loosen up again anyway. So marginal improvements in trade, that's important because China's not a developing nation anymore. Mexico needs to come into the fold and be more legit. Canada, Canada does almost everything right. I don't know who complains about Canada. So, you take a look at the way to trade this, and you have to get past your fear that the world is going to end, right? Because if the world ends, it ends. It only happens every 10 years, 20 years, 30 years, 100 years, whatever it's been. So we had the Great Depression. We had the Great Recession. Are we really going to be set up for another horrible event? Probably not. So there's been some articles out there to talk about the coming pension crisis, coming collapse in the dollar. And let's tell them that I can't talk right now. And none of those things are going to happen. So I'm going to rewrite this article at some point. Look at that. Google knows. That's how popular of an article this was back in the day when I wrote it. Back in 2012, I wrote, they only allow me 1,000 words in these articles here. I'll write a bigger one. All the reasons why the dollar is going to be the reserve currency. And I'm going to make a statement. I hope somebody has got a baby online right now. The dollar will be the reserve currency of the world, or a co-reserve currency with one or two others, for the rest of everybody's life who's living in the world right now. That's simple. There is no way on earth that anybody's going to really push for the yuan to be a reserve currency. Why? They don't have all of these things, right? And ultimately, the reason why, and this is why President Trump's a little dangerous, countries flock to the dollar and dollar assets, and really they're kind of just waiting us out right now because they just figure Trump will be gone in 2 years, is we're not going to screw them. Yeah, we screw them. Yeah, we take our pound of flesh, but in general, assets are safe in the United States, and that's why the dollar is always going to be very strong. So if you take a look at, yeah, I know Avi very well. He was a market watch guy with me. He's pretty good at the technical stuff. I mean, he's a good technical guy. So, the thing is that, and we were talking actually the other day about writing a joint article, but I don't think we see things the same way. He doesn't want anything to do with fundamentals. That's fine. But I will tell you that my returns have probably been better than his because I take leverage and because I know which side the big trends are, right? You use that core 4 analysis of ours. You start by saying, okay, what are the big trends? Well, big trends are in telecom, technology, energy. And how do you play with them? Okay, are the central banks and the government on your side? What are the fundamentals? And then finally you add the you take the quantitative, and I have another quantitative system that I never put up because they wouldn't like that, and then the technicals, right? So all Avi Gilbert is doing is a form of technical analysis, and it's decent. I think it's a little bit cultish, but the quantitative analysis. I've been looking at this stuff for a long time. Back in 2007, when I was giving seminars telling people to sell everything and getting laughed at, I pointed to the technicals and to the quantitative analysis, and people are like, it's voodoo. It's not voodoo. What it is it's measuring the flow of money into and out of markets, and that's important. So when we know that there's big problems in pensions, which is what I was coming round trip from here, is that how do we solve a problem like the pension problem in the United States, where the pensions are on average, 30 to 40% underfunded, right? So you have, can't remember who wrote the article, if I knew his name, but somebody wrote an article about how the pension crisis, there's several articles, and one of John Malden's guys did it too, how the pensions are going to end up crushing the market. No, it's not. The Congress already took steps on how to fix the pensions. So when the day comes, they're just going to drop money into a big old bucket and they're going to fund the pensions. That's what's going to happen. And it's not going to wipe anything out. Ultimately, I think that we get helicopter money, and I think it's going to be fine. If you are a Milton Friedman follower, and I know a lot of people are, then a one-time monetary drop to smooth things out is not only going to work, it's probably going to make the United States even stronger, right? And here's why. Because everybody else is in worse condition than we are, right? So all the countries of the world, save just like 10 or 12, have run up these debts. And so you have shareholders, bondholders around the world who want that money. But a lot of the bondholders are domestic, right? Country to country, a lot of the debt is owned domestically. So if you do helicopter money, coordinated helicopter money, whenever the next crisis is, 2020, I think is as soon as it happens, but 2027, 2028, make a lot of sense as well because of different demographic things. Whenever, who knows, right? I can tell you it's going to happen. I can't tell you when. But whenever the next crisis happens, they're going to do a coordinated money drop. And it's not going to be QE that generates more debt. The governments are just going to say enough is enough. We're all going to print money. We're all going to make sure that it filters in the economy slowly via pensions and social programs and infrastructure building. and it'll work out fine. Will there be a one-time bump in inflation of 4, 5, 6, 7, 10%? Yeah, probably. But the reality is that the deflationary forces of the planet, which we've covered before, offset the inflationary impact of monetary policy. So you just have to manage it over a long period of time, like a mortgage, and it works out. So how do you trade this market? Is you get over your fear. Get over your fear. And when you get these technical pullbacks to around the 200-day moving average, you should buy it almost every time. And you go to your favorite list of stocks and you say, okay, I've been waiting to buy Regeneron. I've been waiting to buy, let me look at my other chart that I have. I've been waiting to buy Nutrien, okay, AT&T. Everybody knows by now that I like Nutrien. Oops, that was wrong symbol. Am I forgot how to type. Everybody knows I like Nutrien. I've been buying it for a while. Every time it got into the 40s, I bought it. It's down $1, 43 cents, about $1 from before that. This is a stock that has a lot of things going for it. They just sold off a chunk of SQL, their SQL ownership. So there was speculation they might merge with SQM, and they didn't. They ended up selling off a hunk. So there you go. So Nutrien is divesting a $4 billion hunk of SQM, which is lithium. But they just raised their dividend again. Oh, in line with the previous, okay. So 3% yield, but this is going to go up. I think you might see a special dividend out of these guys. They essentially control the Western Hemisphere's fertilizer market, and they're doing the same thing with fertilizer that Saudi Arabia is doing with oil, is keeping the supply a shade under demand, and they're just about to achieve that because of they've cut their capex spending for a couple of years. So as the largest producer of potash and top 1 or 2 in phosphates and nitrogen, they're going to start driving the price of fertilizer back up. I believe that this stock can go well over 100 at some point. All right, so the point is that as the market has these hiccups, you're going to want to buy. And the question becomes, when are the hiccups? And that's an important question, right? The hiccups seem to be when President Trump says something that's a little outrageous, but those are like 1 or 2 day hiccups. But this, what is this, right? Why is it doing that? That's the buybacks. Remember I talked about the buybacks. The buybacks don't really happen during the earnings season. So during earnings seasons, you're generally going to get a little bit of a pullback just a little before or after, and that's what you want to buy. So what's going on right now is a little unusual. It has to do with Korea. It has to do with a little bit of extra oil inventory. I think you can buy in those specific spots. But the buybacks are pretty heavy, right? Especially in those biggest companies, AT&T. You want to buy companies that have buybacks, and that's really what we've been focusing on, that and companies that have positive catalysts coming. So asset allocation wise, I meant to build this chart for you. It will be in an article this week. I still want to hold 25-ish% in cash, but I'm going to write puts against it. I want to have 25%-ish in energy. Why? Because I'm aggressive like that. If you only want to have 12% or 15%, I get it. 6% of the S&P 500 is energy. You need to overweight that. So you should be at that 12 to 15% no matter what. But I think you can go 4 times. I think you go 4 times the weighting on energy. Technology needs to be heavy for you. You want to be in all those smart everything companies. Micron. I don't know if anybody asked about Micron. Who's in Micron? Been talking about it for months, right? I hope you're in Micron. So Micron is even up today. You know, that little, I mean, I kept wanting it to get down to 42. Never quite got there, but I was able to buy. I bought some calls before the analyst day, did well. Here you go. It's flirting with that top. Is it going to make it double top and fall off? Or is it going to break through? I don't know, but I'm pretty sure it's going to break through because that $10 billion buyback that starts in September is massive, right? Right after earnings, they're going to start buying shares back. And they're paying off a big hunk of debt, convertibles. Micron's in really good shape. And here's the secret sauce with semiconductors. They're not really cyclical anymore. Smart everything world. This is a massive secular trend. Massive secular trend. So you want to buy Micron on pullbacks, on the big pullbacks, right? Because it's still tech, it's still volatile, it's still semiconductors. You still have a lot of people who don't realize what's going on, so they will push it down from time to time. You gotta understand, 80% of the people trading stocks at any given moment have no freaking idea what they're doing. So you have to play off of that. It's what I'll be doing over in Vegas in June when I'm playing the World Series of Poker tournaments. Is I'm going to try to anticipate what mistakes other people are going to make, right? So those mistakes, if I can anticipate what they are, then maybe I know not to buy a whole bunch right here, but if it drops back down to here, then I know. 50-day moving average maybe. I don't think we're going to see that 200-day moving average again. But as we get close to the 50-day moving average, you probably buy around here. So, we have one subscriber, a guy named Eric, who's involved with technology in Silicon Valley, and he's been very heavily invested in Micron, and he's aggressive with it. Big position, lots of calls, sells puts on the dips, buys calls, and he's done very well for himself. Because he understood before other people, this industry is no longer cyclical, right? Not as cyclical as it used to be. Everything's cyclical, but much less cyclical than it used to be. The cycles are longer, and really it's because there's a huge secular trend pushing this. So whether you go to Micron, if you want a dividend stock,
I'm surprised they list that.
Yeah, you know what? Everybody's supposed to be muted. Let me see if I can mute you.
It is public. It's public information. Anybody else can look at the disciplinary actions, but you're not allowed to say, "Oh, this person's a bad actor."
All right. Manage participants. Mute all. There we go. Somebody unmuted themselves. So in any case, yeah, this is all stuff that is in fact out there. But just take a look at Intel. How's that for a rally of a big doggy blue chip stock? That's pretty good. So you're going to get a lot more of these. Yeah, that is a nice chart, right? And I think Intel's going to 100. I think Micron's going to 100. How long will it take? I don't know, a couple years. And that's why I say you can't be afraid of the end of the world all the time. Here's how you avoid parts of the end of the world. Don't invest in the parts of the economy that aren't growing. Pretty simple, right? So if you, we need to get a little bit more small mid cap. I mean, that is a focus of mine. I like small and mid cap. It has performed well. I think that there will be an international crisis at some point, right? However, you have to take a look at that in the context of who we are and what our economy is here in the United States. We're going to be less affected if Japan hits the wall in a couple years, right? They're still the fourth biggest economy. It's going to be a hiccup for the whole planet. It'll cause a recession. But that's why we want the optionality of having cash. That's why you have to make a commitment to selling puts on a regular basis, because every couple months your cash is recycling. It's always there again. So you can't get into too much trouble if you're constantly recycling that cash. So I am going to do probably 2 videos, maybe from Las Vegas in June, on option trading, because I want everybody to be real familiar with option trading. It's not riskier than stocks, right? If you use options the right way, especially selling cash secured puts, you should look that up, learn it, love it. Selling cash secured puts is safer than actually owning the stock. Why? Because you're collecting a premium up front, and your strike price to buy the stock is 90% of the time lower than the current price, and always on net when you consider a premium lower than the current price. So selling cash secured puts, it helps you keep cash available, right? You just always have cash at the expiration of these options available again, and then you make a decision. So if we're 2-3 weeks into some sort of crisis, you've got cash, right? Got a little bit of cash already, a little bit of cash coming, and you can always trim your positions. So I do think you want to sell the rips on the broad market, but you want to buy the dips on the things that have secular growth, which is technology, which is telecom, which is energy because it's a manipulated market, some commodities because a lot of those commodities are manipulated. I think we're going to talk about soybeans here soon. We want to take a look at all those things where we can get monopoly pricing pressure somehow, right? What does Warren Buffett talk about all the time? He wants durable comparative advantage. He wants monopoly pricing pressure. That's what we're looking for. Where can we find monopoly pricing pressure? Where there's a supply-demand imbalance, where there's some sort of control over the market. Is it the way the world should be? I don't know, but it's the way the world is. So let's not look for good companies that should do okay. Let's look for great companies that have something going for them, some sort of catalyst for growth, some sort of protection of their market. That's what you want. All right, let's fire out some questions. We're almost at an hour. Mexico. I don't know what I was talking about at the time. Somebody keeps asking me about CLNE. I don't know much about them. And they're not on my list. So, I know who they are. Annual hedging of production. Oil production, natural gas production? I'm not really sure. Sorry about your thumb. I don't want General Mills. I've traded Procter & Gamble a little bit. I mentioned it one week. Yeah, so here's the thing with Procter & Gamble. I don't think it can get much cheaper, right? So you got to ask yourself the question, is it going to run back up towards 90-ish at some point? Yeah, probably. But that's a $20 gain, right? That doesn't really excite me. There's no way for Procter & Gamble to run up to 150, right? Just not going to happen. Could you buy it as a trade because you just want to, make the first $10 of this move or $15 of this move? Yeah, you could do that. I wouldn't invest in it. You got people out there who are going to invest in it for the dividend and the turnaround potential. That's fine. You can ride their back for a while because you know what? Those same people who buy it down in here, when it gets to here, they're not going to sell, right? Because, oh my God, it did great for me and the dividend's 3%, but my effective dividend's 4%. Fine. That's fine. I'm not trying to make 10 or 15% a year. I'm trying to make 15 to 25% a year, which means that I need my stocks to run more. So you want to make these trades, go ahead and make these trades. I don't focus on the swing trading in this service. One, because it would be too time intensive for what I charge. But trades like this certainly can be done, right? There's all kinds of blue chippers out there that are going to trade this range. They're going to be those channeling stocks. And if you want to buy Procter & Gamble in here, I think you're fine doing it. But as it gets up to here, you probably dribble out of it because you're losing your upside. So it's the first part of the move that you're looking for. All right. QQQ versus a small cap ETF. I like QQQ. To me, it's a core holding. But I also think IWM is a great holding. And I think, and this is something you have to think about carefully, because there's some theory here. So you've got IWM, and you put QQQ up against it. And lately, they're pretty close. Year to date, I think IWM. Oh no, QQQ is still a little ahead of it. 6 months, 3 months. Oh yeah, it was the last 3 months that IWM outperformed QQQ. Let's take a look at long term. Right? That's long term. That's going back to basically the tech wreck. IWM has outperformed, but now let's change the date. Let's change the date to 2001 or 2002. Okay, let's throw out the tech wreck. If you throw out the tech wreck, QQQ is one, right? So do I like them both? I like them both. I like to pick out the small companies rather than using the indexes, rather than using the ETFs. I know that some people want the ETFs, and that's just fine. You can use the ETFs. But I would prefer to buy companies that are on my list. Go to the breakdown of the capital gain stocks that I have in there, and you take a look. I don't list market cap, and maybe I could. Maybe we'll put that in there. I don't like working on the spreadsheet, so eventually somebody's going to have to just help me. But yeah, I like some of these small companies. So you take a look at Shopify. I haven't owned this in a while. What are they, a couple $1 billion now? They're up to 15 billion, man. I tell you what, when I was playing with Shopify, it was way lower, 5 billion. But you gotta like these small mid-cap companies, and there's reasons for that. Is they get bought out, right? Small companies become big companies because they're growing. That's a Peter Lynch thing. So these companies between $1 billion and 10 billion, man, there's great money to be made there. So if you can find those, and this is where I reach out to the community, you're all in different industries. You, every now and then, find a company that is making huge headway into your industry because they're changing something. There's a telecom company. There's a company, that's working with CenturyLink and Verizon on IoT stuff. I haven't been real public about it, so I'm not going to mention the name. Don't you mention it either. But they're probably going to double or triple. I've been public about Sierra Wireless. I think Sierra Wireless is going to do pretty darn well. I've given interviews on this one. I think Sierra Wireless, this basing pattern down here, this is nice. This is nice. It's going to break up at some point. So, today it's under 18. It hasn't been under 18 in a while. Might be a good time to write some cash secured puts or buy a little starter position. All right. I don't care about interest rates right now. All right. It looks like I'm almost caught up. GE. I don't know. Do you trust GE's management, Thor? I don't know that I do. That's my beef with GE, and unless they want to sell off, I think they should sell off aviation. I'm in a vast minority on that, but I think if they sell off aviation, I like that company a lot better. I think if they become a tech and alternative energy company, that's what I want them to become. Lithium was on my radar a couple of years ago. SQM is my favorite. It's been chopping along for a while after a big rally, right? Something to keep in mind with lithium is production of lithium might outpace Am I getting the symbol right? ALB. There you go. You know, look at these charts, man. They really broke down hard. So here's what's going on in lithium. Right now, lithium is in demand, and there is a lot of hype on EVs and whatnot. The EVs haven't really got there yet, so the stocks are starting to come down. Could they come all the way down to about here? You know, could this come down to 70 for sure? Could it come all the way down to here, 50? Maybe, I don't know. But in the early 2020s, there is a ton of lithium production coming online. And you got to wonder, is it going to be just in time for EVs, or is it going to be early? And if it's early, it's going to beat the heck out of that market, right? So I'm not super excited about lithium from the standpoint of buying it right now. But I would love to get a big blow off bottom on it. A big blow off bottom I would buy. Like I've mentioned 1,000 times, stay away from the middle of these markets. When you're in a spot and you don't know what direction it's going to go, don't guess. Just wait. So either you get a breakout that you can jump on, or you'll get a huge value opportunity that you can buy into. Oil U. Any take on Oil U? I don't even know what it is. Oh, well, that's the same as USOU, I would presume. Yeah, basically the same. So earlier in the call, we talked about USOU. So I'm guessing these two things do about the same thing. USOU. Yeah, they're basically the same. I wonder why that is. Well, for whatever reason, USOU has outperformed it, so stick with USOU instead of Oil U. Yes, I would buy the phone companies before P&G too. Enbridge, yeah. You know, I've been talking about the pipeline companies. They're all going to switch to C Corps. Atra, I don't know what that is. Duh. Got me, man. Something speculative, apparently. I don't know what these guys do. SunPower. It is my third largest holding now. It's almost 6% of my portfolio. And I own a couple of calls. I don't own a lot of leaps right now. I would like to get one of those everybody hates solar moments to buy a bunch of them. So we'll see. To me, SunPower, they just, man, who was just on TV from SunPower? SunPower's got it all figured out. I mean, you got to realize this is Total's mechanism to split into dirty and clean companies. Eventually, Exxon and Chevron are going to have to make that play if they want to survive somewhat healthily. Could Chevron or Exxon or even GE run out and buy First Solar? I think absolutely. So I would, we got to keep our eye on First Solar because that's probably a company we want to get back into. They use mandate banks to hedge close to their forward year. Oh, yeah. Yeah, I was reading about that. I don't know much about it, but Mexico's not a major player right now, so I'm not too worried about it. GameStop update. I am not buying calls yet. So GameStop has to demonstrate to me that they're going to do the things that are necessary to turn it around. And we've talked about what I think they need to do. They need to create destination stores, not Radio Shack stores. They made a mistake when they bought all those Radio Shack stores, right? They got to fix that. What they should do is buy all the Toys R Us. And somebody already bought 300 of the Toys R Us stores. But if you put, you leased out part of a Toys R Us to a restaurant, and you put in virtual gaming and collectibles into those places, and you said, hey, on Thursday, Friday, Saturday, Sunday, we're going to have virtual gaming at night. Oh, man. but you got to be a member of our $39 a month download service. Think about that. Nobody else can do that. GameStop has a chance to become a destination for gamers. And, everybody's looking for something to do with 15, 16, 17, 18-year-old kids, 17, 18, 19, 20-year-old kids because they can't go to bars. What are they going to do? Well, let them go play games. So I think GameStop has an opportunity to reduce their expenses while increasing their revenues on the download side. And their collectibles business is growing quickly. Is this the bottom here? I don't know. I thought we were there already. I didn't think we were coming back below here. So there's the narrative that their company is just going to go out of business because the game exchange business is going away slowly. It won't go away forever all the way, but it's going to go away quite a bit. And that's why they need to consolidate stores. You don't need all these places for people to exchange their games. So I like GameStop as a turnaround play. I know that most turnarounds don't turn around. You don't want to expend a ton of capital on this, but if they start showing signs, you'll want to add to your starter position. All right. Happy Memorial Day weekend. I'm done. And next week will be the last call from my house. And then the next three will be from, the next 2 or 3 will be from Las Vegas. So I don't know. You might actually get to see my round head at some point. Sitting at a pool. Maybe I'll get you some scenery at the Flamingo pool. But in other words, have a great weekend. Don't be afraid of the world. Everything is fixable that gets broken. And if you have a little bit of cash when things get broken, you can make a lot of money. So look for things that appear to be broken, like GameStop, that probably aren't broken. But really what you want is you just want things. You want investments to have the big trends on their side. Telecom, energy, technology. That's the 3 places that I want to be most right now. Take care.